we clearly have an amazing panel to be able to talk about how do we shift the minds of boards and shareholders. We have an hour and a half worth of content that we're going to do in 20 minutes. So excited to start. And you know what? We are going to start directly with the SEC, because if we're thinking that there's any organization that gets a board to act, it's the SEC. So, Mindy, let's start with what's going on. Do we think that anything's going to come out this year?
This year or early next year, but the SEC is merely catching up. What today is about is the fact that companies have, not all and not at the pace and scale we need, captured the concept and started integrating the concept that the risk from climate, from human capital, from losing too many staff, from COVID, that these are risks that run to the heart of their business. And they've got to be factored in as a business imperative, or as the SEC likes to say, a material risk, something that literally will impact the value of the enterprise. The SEC's job is to protect investors. Investors look to the SEC. Companies are required, mandated, to disclose risks when they disclose their 10K and MD&A, to throw around a bunch of silly alphabet soup, but to really disclose what their risks are, so the investors who are investing in the companies know what to invest in. Is this a good company, a bad company, a well-managed company, a company with high risk? The SEC 4 months ago released a draft rule mandating the disclosure of climate risk. I mean, we are seeing hundreds of billions of dollars so far in this calendar year from climate. That's not integrated into our financial systems. The SEC says investors need to know if you're a company and you don't have enough water, or the climate is impacting your apparel because you can't get the cotton crop that you need. Those are real risks. All the SEC is saying, they're not requiring you change everything you do. They are saying in their 507-page rule, which got 14,211 comments, that companies must disclose that risk. Investors need that information, and it also elevates the risk, like any other risk, currency risk, inflation risk, material risk, to the board level of a company. So we've got a draft rule, we've got a new rule, a final rule ready to come out at some point, hopefully this calendar year or shortly thereafter.
Well, and with or without an SEC rule, what you just said sounds like good board management to me, right? Understand the risks to your organization that could come from climate change or other types of ESG factors, for sure. But we all know that with or without the SEC, this is this is something that boards can and should be thinking about for the long run, and has been happening for quite a while. So I would really love for you all to share a little bit about what has been driving this progress and getting boards' attention for the last few years.
Well, regulation, of course, has been happening in Europe, so whether the SEC rules go through or not, let's not forget, in Germany, delivering on climate is a matter of law. It's the same in Holland. Comply or explain in France or the UK. So if American companies want to actually sell products over there, they have to get with the program. And that's important. But there are other things happening too. We talked about the environmental crisis and 2050 goals. We have to get halfway there by 2030. So the urgency to deliver on that is something that boards need to understand, because people are expecting, there's the same level of expectation now of what companies do as what governments do on societal topics, including climate. But there's also a social crisis, using our ESG nomenclature. Let's not forget that half of the workers in the Russell 1000 can't afford to provide for a family of 3, even with both parents working, because real wages have not gone up in America in 40 years. And the net worth of a black family is 1/10 of a white family. And in a context of acute labor scarcity, taking care of your employees now who will leave, we've never seen more attrition ever than we're seeing right now. What that means is that boards need to understand your first customers are your own employees because of the social crisis that's happening. And then, of course, the governance crisis with approval ratings of Congress below 20%. People are saying, well, governments aren't going to get it done fast enough. We're expecting companies to step up. And that's actually what's happening. In addition, demographics, fundamentally different. Generation Z, now 25 to 30% of the workforce, they expect meaningful work. And if they don't get it, they will leave and go somewhere else. And at the same time, boards need to understand that our workforce is not healthy. 40% of the workers in America are complaining of mental health challenges. 70% were not actively engaged at work anyway. COVID has made that worse. Coming back again to the need for boards to understand that we need to do something to engage our workers. Purpose and ESG, of course, is a big driver for that. We're seeing customer activism. 40% of people today are boycotting a brand, not because their product doesn't work, but because of the social stance of that brand or the perceived social stance which they disagree with. That's a big deal. And then, of course, we have regulatory activism, which is happening. What this is doing is raising the bar on companies, and I think we're seeing ESG 2.0 coming. More disclosure, which means more exposure, much more active ownership when we're an employer or an owner. I think the days of passive ownership of assets is dead. If you own a petroleum asset, you are responsible, at least reputationally, for getting it to net zero. And similarly, I think we're seeing a lot better execution now from companies too in delivering against this. Lots for boards to think about.
Disclosure, active ownership, and I'm just going to say I am not Gen Z. I'm not even close to Gen Z, but I do want to have work that is meaningful. But I get that it's the younger generation. Tansi, are you seeing this play out in the research that's happening at NYU Stern?
Yeah, absolutely. I mean, I think we've heard from my colleagues that today sustainability and embedding sustainability core to your business strategy is a business imperative, a strategic imperative. It helps you manage both risk and opportunity. What we see in terms of board credentials, unfortunately, having looked at Fortune 1,188 board members on 100 Fortune 100 companies, is that they have very little ESG experience, right? We're looking at 3 out of 1,188 that had climate credentials, 8 that had cybersecurity credentials. This is a couple of years ago. It's improved slightly, but only slightly. And I think one of the challenges as you work with boards is if they don't know the questions to ask, then you have real challenges, right? And so it's not that you necessarily have to put a climate scientist on your board, but the board needs to understand the strategic imperative. And there's a couple of other points in terms of our research that I'd like to share as we think about how to engage with our boards. First is that just managing to process-based ESG reporting metrics as a reactive approach is not sufficient, right? So often what you see is, unfortunately, organizations are getting, requests for hundreds of different ESG reporting metrics. Those reporting metrics tend to be process-based. In other words, do you have a chemical management policy versus do you have a bio-based dye that's actually improving your performance, right? So if a board and an organization just respond to reporting metrics as opposed to, and this is where the board needs to engage with the executive leadership, understanding what are the material ESG issues for your sector, defining those risks and opportunities, building it into your business strategy, and using it to drive, and this is where we do additional research, which we'll talk about later, return on sustainability investment, drive innovation, drive operational efficiency. If you think about pollution, what is it? It's buying too much to pay to dispose of what's left over, right? But organizations don't think about that way. So there's a whole series of, similarly with, as we heard, employee retention, right? So those, we need board members working with the executive team to understand better the strategic imperative and business opportunity here.
And just one other influence on boards are their owners, their investors.
Yeah.
So we work with about 220 North American investors and 600 globally who want they want to know how well managed companies are. And they define management as managing all risks. That's the fiduciary duty of a corporate board member. So is the board looking at, and is the company managing climate risk, human capital risk? Are they doing enough to train, to give staff a sense of purpose? Are they doing enough to mitigate their climate risk, their water risk? Investors are looking for that in very clear ways on quarterly earnings calls. Many companies are going well beyond that. They're doing special earnings calls just around sustainability issues, human capital, environmental capital, and so on. This is no longer, some companies should do this on a good day. Every investor who's investing in publicly traded companies are reading those SEC filings, but more importantly, engaging with boards on sustainability metrics. And good or bad, we're seeing hundreds of shareholder resolutions when the investors get frustrated and don't feel like a company is moving quickly enough. It ought not to be about shareholder resolutions. It ought to be about a collaborative approach between investors setting broad goals for what they want to see the companies doing to invest in them, and how the companies respond. And one thing that we see that makes a huge difference is tying compensation of the CEO to a sustainability metric. That's the job of the board.
So I just want to point out, if y'all haven't caught it, there have been so many useful statistics for you to tweet from each one of these guys, so make sure you captured them all along the way. And the other thing that we heard materiality from the SEC, what's most important, what's important from investors, and then what's important from the company perspective is what Tansi is sharing. So this concept of focusing on the things that are most important is really a key thing that boards need to think about. Now, the other thing is this shift from short-term thinking of quarterly earnings to long-term thinking, right? Trying to wrap your head around, it's not just what happens next quarter, but 5 years, 7 years, 10 years. So I'd love to hear from each of you, sort of your thought on how we can get boards more comfortable shifting to long-term thinking.
Long-term thinking. Well, actually, a quick build on what Mindy was saying. Because of what you're describing, Mindy, that's why we have to keep E and S and G together under one integrated framework. The Economist got it dead wrong several weeks ago talking about slivering out climate, when in fact, if we lose track of the social and the governance crisis too, then we will lose the plot. We have to keep them integrated. It's the best summary of what a responsible company does. On long-term value, well, first of all, boards need to look at the maths. Companies that think longer term, 5 to 7 years, actually make a ton more money than companies that just focus on the short term. However, 65% of CFOs confess in surveys that they would nix, they would veto a project with a positive net present value if that project ate into the next quarter's earnings. Such is the tyranny of the quarterly analyst call. And yet, if they think 5 to 7 years out, they're going to actually make more money. And we all know what happens. I mean, the thing is, delivering shareholder value is not the same thing as maximizing short-term profits. You can skimp on R&D and safety that will, increase short-term profitability, but it's not going to deliver shareholder value, which includes every stock price includes an assumption built in there on what this company will continue to perform at, what level it will perform at over the longer-term future. That's important. Now, there's no link, there's not a good link between value, shareholder value, and ESG, unless you look at top decile versus bottom decile, or unless you look at most improved. Improving your ratings on ESG does have a bit of a correlation. However, there's a very strong correlation between purpose-driven companies and shareholder value. And many companies make the mistake of jumping to ESG before asking the purpose question. If they jump to ESG, they get a laundry list of things they could do. If they ask, first of all, what's the purpose of our company? Where do our strengths overlap with society's needs? What are the 1 or 2 areas we could really make a difference on? And then build that into their strategy and the way the company operates, then they're going to deliver value. Purpose without ESG is just fluff. That's when CEOs start sounding like yoga instructors. ESG without purpose isn't focused. And companies need to marry these 2 concepts together to really get the magic. And then, of course, embedding it all the way down into the way they operate becomes a key factor.
And Tansi, there's something about how you measure as well. I think that's part of this challenge.
Yeah, absolutely. So we've been doing work around the return on sustainability investment, understanding what are the drivers of better financial performance when you embed sustainability core to business strategy. And those drivers include innovation and growth, operational efficiency, risk mitigation, employee engagement, retention, et cetera. One of the challenges that we see that drives more of the short-term approach and that boards need to grapple with is the challenges we have with our current accounting systems, right? So to give you an example, CFOs don't currently track generally avoided cost, yet a lot of circularity strategies and waste management strategies are about avoiding cost. So we looked, for example, at automotive company, their waste management strategies was driving $235 million annually of benefit to their bottom line, which they did not know because they were not tracking, for example, the fact that they were no longer buying virgin paint and solvents because they were recycling them. They no longer had to pay the waste disposal costs, and actually they had some left over which they were selling. They didn't put that all together to assess it. Similarly, I was just talking with, sort of on the innovation front, we do a lot of research around consumer purchasing of sustainable products in CPG in the United States, looking at actual purchasing, right? We work with IRI that collects all of our barcode data at retail. What we've seen there is that sustainably marketed products are growing 3 times faster than conventional products at, on average, a 28% premium. Last year, we saw $3.4 billion of carbon-labeled product introduced, up from $1.3 billion the year before, up from 0 the year before that. Last year, we saw 1 out of every 2 new products in CPG introduced had a sustainability attribute. What we also saw, and I'll show you the downside of not paying attention to these trends, which a lot of boards are not, is when we first started doing this back in 2019, we saw that conventional dairy was at negative 10% growth, and sustainable alternatives were at plus 10%. 6 months later, the 2 largest dairy producers in the United States declared bankruptcy. Those boards were asleep at the switch, right? So these types of trends are critical to your future as a company, and you need to be managing for them.
You know, the tyranny of short-termism, as you said, is very real. That's the job of the board, to break through, to question the CFO, to question the CEO. Think about an apparel company, a food company, and we've looked at many of them. It may be they get a good quarter. It may very well be. But if next quarter or the quarter after and the quarter after that, they haven't considered water risk, water that they need unlimited amounts to run their manufacturing or to run their farms or to make sure their cotton crops are vital. When the cotton crop of Levi Strauss and dozens of other companies, the Gap and other companies that thrive off of cotton, were either drowned one year by too much water or dried out by too much water, those are things that cause the companies to lose 3%, 4% share value. It is the core. So if they are not factoring into their planning and their mitigation, if they thrive and survive and their business depends on unlimited water, and the climate is changing and our water patterns are changing, and we know we have 30% less water than we need as a world community, it's not impressive that they did this well this quarter, but the next quarter, there's a drought. Farms were being farmed at literally half the value of their farms. Farm workers laid off. Food prices go up. Prices of clothing goes up. That's the role of the board, to look at something more than quarterly earnings and to expect that of their teams to deliver. And I think boards are asking more and more questions.
And Mindy, do you think that investors are also taking more of a longer-term view, or are the investors pushing them to have the quarterly response?
Well, there's always a little bit of both.
Yeah.
And we see that with companies as well. We work with, on one particular initiative, 600 global investors who are saying to the 100 largest emitters of greenhouse gases, we want you to manage your enterprise differently. We want to see you get to a net zero future and get halfway there by 2030. Those investors are saying, show us the plan. And that plan is not going to be solved in one quarter. Mm-hmm. They want to see a plan with specific goals and with short, medium, and long-term metrics that show how they're going to reach the goals. As you said, you know, words are words and commitments are commitments, but without clear KPIs or metrics to make sure those things happen on a time-certain way, they're not going to happen. And investors are, particularly around climate on water, but around human capital as well as they should be, expecting that and looking at a longer-term picture.
That's great news. And I have 27 more questions and 27 more seconds for this panel. So I don't think that's going to work out really well. What I do want to point out is that Tansi has done a tremendous amount of research, and just Google her name and you can get a lot of the statistics and everything. Ceres has a tremendous amount of data on their website, particularly tracking shareholder resolutions. Hopefully, we will all be around most of the day to continue this conversation, and I'm very grateful to the three of you and to all y'all for listening in today.